It's time now for the political analysis of Fromm and Fuller. Al Fromm, former political advisor to President Bill Clinton, and Craig Fuller, former political advisor to both President Ronald Reagan and George H.W. Bush. Good morning, all. Al, we are going to start with you. And of course, the big news over the last couple of days is the failure of the Silicon Valley Bank. And I'm sure many people, including you two, looked at that and had a moment of deja vu to 2008 and the incredible political circumstances related to that failure. I think it's a matter of public record that the Republicans successfully reduced the level of supervision over our banking system over the last 2 years under the Trump administration. So let's get your point of view.
I have to tell you, I'm not an expert on banking and banking regulation. But what I do know is that Silicon Valley Bank is an unusual bank in a number of ways, some of which caused its collapse. But for one thing, it's the Bank of Silicon Valley. It finances a lot of startups. I was at an event on Saturday in DC, and one of the people there was a former employee of mine who runs the biggest and most important trade association in Silicon Valley, representing all those companies. And her concern was whether she was going to be able to make her payroll on Wednesday, because all of their money was in Silicon Valley Bank. Let's step back for a minute, because this is hard. This is complicated for me, and so while there may be people who are watching us who know a lot more about banking than I do, I just thought I'd try to put this in a little context. After the collapse in 2008 and 9, Congress passed the Dodd-Frank Act, and one of the provisions was that there was very strict scrutiny over banks that had more than $50 billion in assets. That didn't sit well with this guy, Greg Becker, who is the CEO of the Silicon Valley Bank. And he was among the first to start lobbying to up that amount. And the Republican, or the Congress in 2018, so it would have been before, while the Republicans still had control, raised the threshold to $250 billion. So that banks that were under $250 billion got less scrutiny and less oversight. Interestingly, Silicon Valley Bank in that period went from right about 50 billion, I think I saw somewhere they were at 49 billion, still trying to avoid the scrutiny, to $220 billion, but they kept under that $250 billion threshold. Well, what happened was they made a lot of bad investments. Becker bet the bank on basically long-term bonds. And as interest rates went up, the value of the long-term bonds went down. And as a result, the assets the bank had decreased. And about a little over a week ago, they announced that they had a $1.8 billion loss in assets. That triggered a run on the bank, a panic. And last Friday, I believe it was, depositors withdrew $40 billion in one day, and the bank collapsed. Just to put this in some perspective, an average bank puts about 6% of its investments in long-term bank bonds. Silicon Valley Bank put 75% of its investments. So the CEO, who wanted to avoid scrutiny, went his own way essentially, and he paid an enormous price because he didn't have a diversified portfolio to absorb losses. What's the political fallout? I don't think we really know at this point. It depends on what happens, what this collapse triggers. I mean, early signs are not particularly good because yesterday it had a real impact on the international markets. Credit Suisse, which is another bank, a big Swiss bank that has had bad management problems, needs a bailout, essentially a bailout. We don't know whether there are going to be more failures here. We don't know what the impact will be. I mean, what happened in 2008 is within a week, basically the economy collapsed and all sorts of banks failed. And that turned the election. I mean, John McCain was dead a week after Labor Day because of the collapse of the economy.
Right.
We don't know whether this is going to affect the fight against inflation. Maybe it's going to make the Fed a little less likely to try to squeeze out inflation. We don't know. I guess what my conclusion is, a single event, even as important as the 16th largest bank in the country going belly up, probably is not by itself going to have an enormous impact on the political world. But if it does trigger economic distress, I mean, voters don't really know very much about regulation, bank regulation. My guess is if you went out on the street, even in a town as sophisticated as Easton, and asked people what Dodd-Frank was, you'd get all sorts of answers. But what they do know is what happens to their own pocketbook. So that's really going to be the test. The economic fallout is really going to be the political test of what kind of impact this is going to have.
Craig, I mean, what's your take? I mean, I think that the last time this happened, I think a lot of people gave President Bush a lot of credit for a lot of bipartisan support for what was at that time pretty radical, remediation on that crisis. What's your thoughts?
Well, there are a number of actors here, and Al has kind of characterized them, I think, accurately and explained that. I want to start with a short story. It was a long time ago in the 1970s, and I had a client who was not only the chairman of one of California's banks, United California Bank, he was the head of the California Bankers Association. Banks are very strong lobbying organizations, and my task was to get him in front of the recently elected Jerry Brown. I won't even go into how all that happened, but we go to Sacramento, we sit and wait in the governor's office, 20 minutes, 30 minutes, 45 minutes. Governor Brown was notoriously late. And Norm Barker, who was the CEO, was, if you looked up banker in the dictionary, you'd see his picture. He was just so stereotypic, pinstripe, blue pinstripe suit. And he had a very tight presentation. He knew his time would be limited, and he wanted to lay out the major issues facing banking at the time in the state of California. And we get ushered into the governor's office, and the governor could not have been more gracious. And Mr. Barker starts his presentation, and Governor Brown says, Norm, just stop for just a minute. He's never met him before. Norm, stop for a minute. I got a question. So he stops, and Jerry Brown looks at him and he says, why do we need banks? At which point this banking CEO about collapsed into the chair. But it's not a bad question. And I think that one of the things, Al's quite right, people don't understand and wouldn't understand the banking regulations and all that, but they think banks are a place where they can put their money and it will be secure. And I think I don't even think we're in the middle of this story. I think there's a lot more to be told, but it is clear that Silicon Valley Bank maximized the profitability for the owners of the bank and minimized the security for those who were putting deposits in there. And then I think they probably also ran it a bit as a club, and meaning that it was the thing to do. It was the place to be. And at first I thought, well, no one's going to be too sympathetic about billion-dollar biotech companies and their executives losing some money. But then I found out there were 400 wineries that were using that bank. And they're the ones, as Al suggested, that had a hard time, meeting payroll. And They didn't even know whether to send money to the bank, and they didn't know what was going to happen to it. But it was that bank and the way in which it was run to maximize profitability for the leadership that I think has a lot of answering to do. The fact that reports, and I looked at the backgrounds of the board of directors, only one member of the board had banking experience. That kind of oversight, ought to include people that know something about banking. And in a real twist, the former CEO of Silicon Valley Bank, who saw to the growth and also lobbied for raising the limit by which the bank is regulated and supervised, that individual was sitting up until he quit last week, sitting on the Fed in San Francisco, the Fed board in San Francisco, the very group that was supposed to be monitoring banks across the region. So Congress is quick to, and some are quick to jump and blame the Fed, but Congress is the one that raised that limit. And it was Republicans, but it wasn't just Republicans in Congress who did this. And it was the banking lobby who really demanded it. And so the banks with less than 250 billion had there was less oversight, less supervision than banks over that level. I do think there'll be consequences. There's stories today that the Fed is getting ready to increase rules and regulations. Hopefully it's not an overreaction. Billions of dollars are flowing into large banks, and it was the large banks that created a problem for the country for a whole set of different reasons in 2008. So there's a lot more to be learned about this, but I do think it's a story of a bank operated in a way that was not consistent with the norm, to be sure, and federal regulators who were limited by a Congress who responded to the banking lobby.
Yeah.
If you can sort all that out, you can get to the bottom of this story, but it's going to take some time.
Al, a trigger word or words is bank bailout.
Right.
That is a rallying cry for a certain political philosophy. I suspect we're going to see that more and more as you say, more information comes out. How do Democrats counterpoint that?
First of all, I believe you said that President Bush got high marks for what he did in 2008, bipartisanship, and that is true. But he wasn't running in 2008. John McCain was. And just as Bush was getting high marks, the actual candidate of the Republican Party got tossed to the wayside. If you remember, coming out of the Republican convention was the only time that McCain was leading, because he had successfully turned the point of the election from whatever Obama wanted it to national security, which was his strength. Well, it took a couple of bank collapses to turn that right back to the economy on Obama's grounds, and McCain was never heard from in the campaign after that. So, I mean, I don't think anything ever good comes out of a situation where you have to make up billions and billions of lost dollars of other people's money that the banks lose. I mean, in this case, I understand that President Biden has said that the depositors are not going to lose anything, or at least those who aren't shareholders in the bank. But the FDIC has a limit of $250,000 of guarantee per account. Many of these people had tens of millions of dollars in the bank. And so it's going to be a lot of money. It's going to be hundreds of millions of dollars at least that they're going to have to, probably billions, that somebody's going to have to make up. I sort of think that's bailing out the bank. Now the president says it's not going to cost taxpayers anything, but because it'll come from some insurance fund that the banks fund. it's hard for me to believe that if you get into billions of dollars of losses, in the end, the federal government doesn't have anything to do with it. Look, I don't know how the Democrats or the Republicans are going to handle it, but it really doesn't matter what the rhetoric is, because in the end, if there are enormous economic consequences and they're felt on Main Street, the party in power gets the blame. And unfortunately for President Biden, for all the great things he's done, if things go sour because of this, they're triggered by this bank failure, he's going to pay the price.
Greg, you have the last word this week.
Well, George Bush had a saying that he'd used from time to time, that nobody writes a story about the banks that weren't robbed today. Meaning, and I think about that, and I think, you know, across the land, thousands and thousands of banks are operating just fine today. Depositors don't have money at risk today. And I think, as I've heard others who are more knowledgeable about this than I suggest, you know, now is not the time to panic. I do think that we have a system that protects the depositors of banks, even banks that may be poorly run. And I do think in many ways, you've got to hand it to the Fed that they acted pretty quickly to at least give assurance to people that their money was safe, or that they would be able to get their money back. And the way most of these things work out, whether it's through insurance, whether it's through increased value of bank stock or whatever it is, it doesn't, at the end of the day, the government is a bridge, and the loss to the taxpayer is not huge. And I think, while in some ways, you know, it's blowing right past the $250,000 guaranteed protection, seemed maybe a little quick. It did have the result of, I think, slowing people's concern. It is a reminder, though, that our economy is very fragile. And I think Al is exactly right, that if there's a downturn, if this has longer term consequences, those in power will have to answer for that. It may turn the heads of some of the Republican leadership in the House, I don't know, to suggest that you know, this is no time to be reckless or anything other than cautious about things like debt ceiling and financial issues, but time will tell. I suspect we're going to see a pretty interesting book followed by a great movie out of this whole episode. It's quite a story.
Yeah, it is. Well, we have to leave it there. Craig Fuller, Al Fromm, thank you so much indeed. We will see you next week.